let's come to the most important part about the yen carry trade. Now, in the earlier slides we spoke about, we said, see, the differential between the US interest rate and the Bank of Japan's interest rate determines how strong or how weak the yen would be. If you can see the overlay on this chart, the light gray bars are the yen. You can see that as the gap between the Federal Reserve's interest rate and the Bank of Japan narrows, the yen sees an appreciation, and post that, as the gap starts widening, the yen starts depreciating. Now, it is very important to understand what a carry trade is. Carry trade, in very simple terms, is somebody, let's say X, buying cheap and investing that money in higher yields abroad. The most important aspect here is that the currency should not move in an unfavorable direction. So if you look at this small para here, the trade, this carry trade, will go on till the exchange rate of the country you invest in. Say, for example, you're investing in the US by borrowing from Japan. The US dollar should remain stronger. The minute the US dollar starts weakening, this entire trade might not really be very profitable. You can take a look at this example here. So X borrows 78,000 yen, which is roughly around $1,000 equivalent in 2012 for 0% interest rate. And let's say the exchange rate then was around 78 yen to the dollar. Now X invests this in US treasuries at 1.5%. Now, if he holds on to this trade for, let's say, around 12 years, and currently the yen dollar exchange rate is 147, if she repays this now, closes the trade, instead of repaying $1,000 equivalent, she will only be repaying around $478 equivalent, which means that 75% of the profit that you have made in this carry trade comes largely only from foreign exchange. So when the market started expecting that the currency would start witnessing a sharp appreciation spell, naturally it started getting a little worried, and it said, maybe we will have to start unwinding our carry trades, because if it comes closer to the exchange rate at which we started, then for all possibility, the carry trades will start making losses. Now, this is the most important. And therefore, when carry trades unwind, because these carry trades generally are leveraged. For example, if I have 100 rupees, I will leverage that, and it will be this leveraged money that will be invested in these carry trades, which means when these carry trades unwind, they tend to distort markets, because there's a significant amount of carry trades that are getting unwound because a lot of leveraged money is getting unwound. Now, this is largely what you really need to know about the carry trade.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.